For years, my core portfolio was as simple as it gets. One global equity fund, 100% invested in the stock market. And it worked. Strong returns, steady contributions, and I hit my number. And that's exactly why I changed it. Because at some point, the most important investing question stops being, how do I get the highest return? And it becomes, how much risk do I actually need to take? So in this video, I'll dig into my reasons for the change, how that's actually the latest phase in my development as an investor, what funds I now own, and also what general lessons you might take from my experience. And if you do find this video helpful, then why not subscribe to our channel and of course like the video. Why just one global equity fund, you might wonder? Well, your decision about how much risk to take is usually driven by three factors. One of them is your investment horizon, and that means how long until you actually need the money. The second one is your risk capacity. So that's whether if you do make a loss, it's going to affect your quality of life or your lifestyle. And then the third factor is your risk appetite. So that's how much volatility you can stomach or tolerate. And if there is an equity market crash, how stressful you'll find that. So when I went for the 100% equity portfolio, I certainly had a long horizon. I just started PensionCraft and I wasn't going to quit anytime soon. And I was getting a reasonable income from PensionCraft, so I probably wouldn't need the money for some period of time. And that meant the volatility was something I could quite happily live with. I didn't like it, nobody likes making a loss, but I could live with it. Also, global equity offered me broad diversification across different countries, different sectors, so it wasn't just concentrated in one stock or sector. Also, the research I'd done showed me that equity market returns were just so much better than other asset classes. Another really important factor for me was simplicity. Just having one fund was a really good way of keeping my own behaviour in check. And that's because I wasn't tempted to tweak the portfolio or try and forecast what was about to happen in markets and adjust my allocation accordingly. So it offered a huge behavioural benefit, and I could control my own behaviour much better with one fund. There were just fewer decisions to make. However, before we go any further, there is an important warning I'd like to share with you. And that's not to copy my portfolio. Now, I always say this, don't copy my portfolio, but I often see that people have copied what I've done. I can kind of see why you'd do that, but remember that your circumstances, particularly along those three axes of investment horizon, risk capacity, risk appetite, are extremely unlikely to be the same as mine. Also, I have absolutely no idea what's going to happen to markets, and I don't pretend that I do. And yes, I make mistakes, I get things wrong, and my portfolio, keeping it that simple, was one way to try and avoid those mistakes. So this video, like all my videos, is not about telling you what to buy. It's about telling you how to think about asset allocation, and what you should always do is take what I say critically. Use it as a starting point for your own research. So with that framing out of the way, here's why I changed my portfolio. Now the key word here is enough, because I had two things happen at roughly the same time. The first one, and it was a matter of luck, was that there was a period of very strong equity market returns when I happened to have 100% equity exposure. The second lucky factor was the success of PensionCraft. I actually didn't think it would be as successful as it was, but we did manage to grow our revenue very rapidly and also our investment community rapidly. And that meant that I could carry on making contributions to my investments, which I wasn't able to do initially with PensionCraft. So that lucky combination of two things essentially meant that I could reach my number. Now, what do I mean by my number? It just means that I've got enough so that if I stopped working in a few years' time, I'd be absolutely fine. In fact, I could probably stop work now and not receive any further income and just live off my savings for the rest of my life. Now that means different things to different people. My number is probably a lot smaller than other people's, and that's because my idea of a good lifestyle, the things that I enjoy, are not about lavish expenditure. I'm not the kind of person that wants to live in a huge mansion with a Lamborghini or a fleet of Lamborghinis, because that's just not who I am. That's not what makes me happy. The amount of money I now have is sufficient for the lifestyle I want. And the kind of things I enjoy are going for a walk in the woods with Teddy, my dog. It's not about really expensive things. It's not about bling. And then the final thing which made me pull the trigger was pretty much to do with circumstances. I was transferring my pension from one platform to another, and I transferred it in cash. Now, that meant that I had to sell what I had and move it to the new platform, and then I had to buy back equity. But as I did so, I was thinking, do I really need all of this equity back in my portfolio? And I realized after some simulations and some cash flow modeling that actually no, I didn't need to have all of that risk. And again, I was lucky with the timing. So if you look at the period when I sold, you can see that with the vertical line here, the dashed yellow line. That's when I had to sell everything. And that was just before we got the big sell-off in 2025 with Liberation Day. And then the points when I bought back in are shown in red. And you can see that I bought back in at a discount. But what I've learned from this experience is that you should only take as much risk as you need. To understand my decision, I think it really helps to understand my history as an investor. And I break that into 4 phases. Phase 1 of that would be I am an asset allocator, because when I left investment banking, that's the job I had previously. Now, I thought that I could take a portfolio and have the same granularity, the same detail as I had when I was a strategist. So that meant I'd have regions for equity. So we'd have Europe, Japan, UK, US, and so on. And then I could decide which regions to tilt towards, and also between asset classes. So for example, how much in equity, how much in bonds, how much in commodities. And of course, we had the huge resources of an investment bank behind my team. So for example, we had the entire economics department who'd have calls on all of those macroeconomic variables like growth, rates, but also inflation. And of course, we also had the single asset type strategists for commodities, for fixed income, for credit derivatives, for almost everything you could imagine. And also we had the single asset class strategists who'd feed into our decision, and we had the single stock analysts. So I think it was pretty arrogant of me to think that I could do what I'd done previously without all of those resources behind me. After all, it was just me and my dog who were making these decisions. Phase 2 I'd characterize as simple and cautious. Now, I'd just gone through a divorce, so I thought I initially had this much money. Turned out I had that much money, and that wasn't going to be sufficient to retire for some time. And early on, I earned almost zero with PensionCraft, and I can't tell you how difficult that period was. I was tutoring kids in physics and maths in order to make ends meet, and although I enjoyed that experience, I love physics and maths, it wasn't an easy period. And it wasn't clear that I'd ever have more capital to invest, so it was very much a matter of preserving the capital I had, and that's why I was very cautious. My portfolio was very much skewed towards fixed income, so funds like Life Strategy 20, bond funds, and so on. And the reason why I simplified my portfolio was because of something that one of our community members said. He said, look, why are you trying to make your portfolio really complicated? You'd have been better off with a really simple portfolio. You're always telling people to make their portfolio simple. You should do that with your own portfolio. And I realized that that person, Louis, thank you, was absolutely right. So I had a simple and very low risk portfolio as a result. I'd characterize phase 3 as simple and risky, because what happened was that the simplicity was spot on. That worked really well, but caution wasn't any longer required. And the reason for that was that PensionCraft started to take off. More people were watching our videos, and we also had our income increasing rapidly. And that meant that I could make contributions into my ISA and my SIP. So suddenly it looked like I'd have another bite of the cherry, and 100% global equity seemed much more realistic. I wouldn't need the money for some period of time. I was getting my income via PensionCraft, which I really enjoyed, and I started to drip feed money into my ISA, and I started to drip feed into 100% equity. Now, I am quite cautious by nature, so I had a very long drip feed period, which you can see here between 2021 and 2023. Markets were largely range-bound global equity markets at the time. And you can see how lucky I was, because just at the end of the drip feed period, we had this huge jump upwards in equity markets. And that's a rally that's lasted pretty much to the present day of around over 40%. So my overall investment returns, including the beginning of the drip feed period, were about 60% over that period, which is, I'll admit it, lucky. I was on more than one platform, and that meant that on different platforms I'd use different global equity funds. But you can see that the choice of global equity fund hardly makes any difference. The returns, the risk are going to be very similar. There's only one world to buy, and buying the cheapest fund was usually what I'd go for each of those platforms. So on Vanguard you can only buy their own funds, and I switched from FTSE Global All Cap to VHVG, which is a developed market only fund, but you can see that didn't make a huge difference to the returns. And then later on I switched into ACWI when I moved on to platforms which allowed me to hold non-Vanguard ETFs. Another fund I've been using is FWRG, again a global equity fund. At the same time, I realized that I did want to play around with stuff. So what I did was I took a 90-10 structure where 90% of my portfolio was invested in this core, and then 10% was fun stuff. And there I could experiment and buy things which were toxic because it was fun. And then I could try and beat the market. So my core is trying to buy the market, and my 10%, my fund portfolio, was trying to beat the market and usually failing, but having fun doing so, and also learning about markets doing so. And of course the fund portfolio had a secondary role, which was that it kept my hands off the core. I wasn't tempted to fiddle with it because I was fiddling with the 10%. And that brings us to phase 4, which I'd characterize as I've got enough. So as we've seen, this equity rally really worked well for me, and I was quite lucky with the timing. Plus, the luck with PensionCraft also meant that I could make larger contributions. And the combination of those two things meant that I hit my number. And as a result, I went through this mindset shift from accumulation to protecting my capital. Now, I love this anecdote with Joseph Heller and Kurt Vonnegut, where they were at a party together hosted by a billionaire. And Vonnegut said to Heller, the host has probably made more in a single day than your book, Catch-22, has ever earned. And Heller replied that he has something that the billionaire will never have, the knowledge that he has enough. So knowing you have enough changes absolutely everything. So now I've gone from one fund to two funds. Which funds do I own? So I've still got quite a bit of risk in my portfolio. 60% equity is still pretty high. And of course, I still want returns because I have to beat inflation. And of course, it's always best to have a bit of leeway in case there is a big spike in inflation or a very poor period of returns in the future. So I still need to beat inflation, and I think the equity will help me achieve that. So I've still got a global equity ETF in my portfolio, and you can see some alternatives here, and there isn't much to choose between them other than the fee. Then on the fixed income side, the 40%, I'm currently in a money market fund, and again, these are pretty similar. So I've got an accumulation sterling denominated money market fund, but I'm going to keep an eye on yields, because if money market funds give me significantly less than, say, gilts or global bond funds, then I'll switch into whatever gives me the better return without increasing the risk too much by taking more duration risk. So this is what the yield curve in the UK looks like right now as I shoot this video. And you can see that the SONIA rate, which is the dashed line you can see here, that's what you'd earn roughly with a money market fund. Now, the Bank of England just cut interest rates to 3.75%, and that means that some of these gilts are going to become more attractive as that rate falls. So if it was the case that those gilts held to maturity are going to give me a better return than money market funds, I could always switch into a single gilt bond ladder. And incidentally, if you did want to join PensionCraft and have access to those tools that you just saw, plus lots of members-only videos, I think I've made 300 of them now, and also our chat application, so you can ask a question whenever you want. It's really easy to do that. You're not locked in for any period of time. Just go to our website to learn more. That would be pensioncraft.com/membership, and also there'll be a link in the description below. But that's what I own right now, a global equity fund in different flavors on different platforms. On Vanguard, it's still VHVG. On other platforms, it's FWRG and ACWI, the ACWI Tracker Index from State Street. But really, both of those funds are fungible. You can substitute any of the other ones in the same category, and it wouldn't make a huge difference to the risk and return. Now let's turn to the broader lessons that you can take from my experience. The first point, I think, is that investment is incredibly personal. As you evolve, as your knowledge evolves, and as your circumstances evolve over your lifetime, then your portfolio might change with you. Now, that doesn't mean that you're constantly tinkering with your portfolio every day, every week. In fact, what you should do is be hands-off, but once in a while reevaluate whether what you've got is appropriate for you. Secondly, you should know when you have enough. There are various ways to estimate that. Some people use a 4% rule. In PensionCraft, we've got various Monte Carlo simulation tools. We've also got cash flow modeling tools in collaboration with My Finance Future. You get a big discount if you join our community. Whatever the tool you use, even if it's just a spreadsheet, you should have a rough idea of when you've got enough to retire, because that completely changes the game. Because at that point, it's more about capital preservation than it is about maximizing return. Now, some people will still choose to take lots of risk at that point. However, I'm quite cautious and I decided to dial back. And that brings me on to the point about risk appetite. Some people think it's kind of cool to have lots of equity, and it's a bit of a wimpy thing to have less equity in your portfolio, but you should always be true to your own nature. Don't have lots of equity because other people do, because a YouTuber says that that's what they've got. Just do what's appropriate for you. It's not an irreversible decision, and it may be that you have to go through a period of a sell-off before you find what is right for you. But risk appetite is really important. And even if you have a long investment horizon and you've got a big risk capacity, that doesn't mean you have to take a lot of risk if it's inconsistent with your risk appetite. Another point is about simplicity and cleverness. Lots of people assume that if you're clever, if you're a professional finance person, you're going to have a really complicated portfolio with sheets of different assets. Whereas what I've actually learnt is that the best thing I ever did was to radically simplify my portfolio. Managing it is easy, and managing my own behavior is very easy now that it's simpler. Also, what I've discovered is that now I've de-risked, that safe investment, the money market fund, is actually stopping me from worrying. Because if equity markets did tank, I could deploy some of that dry powder just by rebalancing my portfolio to buy back some equity at depressed prices. And that historically has been shown to increase the returns of your portfolio. But more importantly, it gives me that psychological cushion. But don't get hung up on trying to find an absolutely perfect portfolio, because there is no such thing. And if there was, it'll probably change over the course of your life. The thing to really focus on is whether that portfolio will make you reach your financial goals. But I think the most important thing that I've learnt overall is that the hardest part of investing isn't about choosing assets, that's asset allocation. It's knowing when you've already won. So I wonder if you know your number. Why not say in the comments below whether you think you've reached it or whether you think it's a useful idea at all. Not everyone thinks they have a kind of hard target. It really depends on what your goals are. And some people don't want to stop working. They want to carry on. And I think I fall into that boat. You could say I've already retired and this is my retirement job. And don't forget, if you did want to learn more about investing and working out what your number is, and also discussing that with other people who've reached their number and some people who haven't, then why not join our community? It's really easy. Just go to pensioncraft.com/membership to learn more. And as always, thank you for listening.